If you've been thinking about buying a home, but you're not sure if you should buy now or wait a little while because home prices have begun to fall, well, you're in the right place because I'm going to be breaking it all down in this video. Home prices are finally starting to fall, and this comes at a time after we saw home prices rise at the fastest rates we've ever seen before. This is where you have a lot of wannabe home buyers sitting on the sidelines confused because nobody wants to go out and buy a home right before home prices crash. So what do? Should you buy now and risk home prices potentially falling, or should you wait but then risk home prices going up even more? There's two parts to this. First, you have to look at the price of the home, and then you have to look at the cost of the actual mortgage. Now, people don't actually buy homes based off of how much a home costs. People buy homes based off of how much the mortgage will cost them. This became very apparent over the last couple of years because even though home prices skyrocketed, people were still willing to pay top dollar and more over asking price to buy these expensive homes because they were able to get a mortgage rate that was super cheap. So if your goal is to get the best deal possible on a home, you don't want to just look at where home prices are going. You also want to look at where mortgage rates are going, and this is where we're going to start. We're going to go from the bottom up and talk about what influences mortgage rates and where mortgage rates are going. Then we'll talk about home prices. But one caveat that I do want to say before we jump into that is if you're thinking about buying a home, remember your home is the place where you live, and the most important thing isn't trying to time the market when it comes to buying your home. It's buying a home that you can afford, because the way that I look at it is your home is a liability. It's a liability until you sell it, and then you have to hope that you can sell your home for a profit where there's no guarantee. So the most important thing is that you can buy a home that you can afford, not when you buy it, but actually buying a home where you can comfortably afford the cost of the home. The two major factors that influence mortgage rates are the Federal Reserve Bank and inflation for two different reasons. First, when it comes to the Federal Reserve Bank, the Federal Reserve Bank is the central bank here in the United States, and they're the entity that's in charge of interest rates. Now, while the Federal Reserve Bank can change interest rates, they're not changing mortgage rates. The interest rates that the Federal Reserve Bank influences is called the federal funds rate. This federal funds rate is the interest rate that banks pay one another for overnight lending. So you can kind of think of it like the wholesale price that banks have to pay to borrow money, and then they sell you this money at the retail price. Banks pay a certain rate to borrow money. This is the federal funds rate, and then they're going to mark it up and sell it to you at the mortgage rate, which is the retail price. So when the Federal Reserve Bank raises interest rates, the cost to the bank goes up, which means that they're going to have to raise their price to you. The way inflation influences the mortgage market is a little bit more complex because it has to do with two factors. You have to look at inflation and you have to look at the bond market. Bonds are loans, and in this bond market, you have the ability to loan money to the government. This is called a treasury bond, and you can also loan money into the mortgage market called mortgage-backed securities. Now, when you have high inflation, that means that the value of the dollar is dropping. So when you have high inflation, people are typically worried about the health of the dollar because that means the value of the dollar is going down. Now, when the value of the dollar is dropping, that makes it less attractive to people to loan money to the United States government because the government relies on the health of the dollar, right? Our dollar is our reserve currency here in the United States. So when people are worried about high inflation, they don't want to loan as much money to the government because they're worried about the health of our economy. They're worried about the health of the government. They're worried about the health of the dollar. Now, the government, in order to attract more investors to loan money to the government, meaning to get more people to put money into treasury bonds, the government will then have to raise the yield, meaning raise the interest rate that they pay on these treasury bonds. So when you have high inflation, that means that the treasury yield also goes up, meaning that the interest rate that the government pays also goes up. High inflation, higher treasury yields. But the issue here is treasury bonds are known to be the safest investment around. Why? Because these treasury bonds are backed by the full faith and credit of the United States. You'll see why this all matters for the mortgage market in just a second. So if the treasury market, the treasury bond market, is supposed to be the safest yield, that means it should also give you the lowest return. Because risk versus reward. Higher risk should give you higher potential reward. So now, if the treasury bonds have to go up in yield, meaning the government has to pay you higher interest rates, that means then for the mortgage market, mortgage-backed securities, they're going to have to give you an even higher yield because it would be a really weird scenario if you could get a better return on your money by lending your money into the mortgage market than lending your money to the government. This wouldn't make much sense. So this is why when you see treasury yields go up, you also see mortgage rates go up because you have to have a higher yield on these mortgage-backed securities and mortgage rates in order to compensate for the higher treasury yields. So when you have high inflation, that forces treasury yields to go up, which also forces mortgage rates to go up. These two factors together then influence which direction mortgage rates go. Now, we just saw the Federal Reserve Bank raise interest rates again in 2023, and as of today, it looks like the Federal Reserve Bank is going to continue raising interest rates in 2023, and at the very least, keep interest rates where they are. The Federal Reserve Bank has said that they have no intention of cutting interest rates in 2023. So on this end, it looks like mortgage rates will continue to go up because of this. Now, on the inflationary side, you have a lot of different opinions here. Inflation has come down pretty significantly off of its highs. Inflation has cooled down, but it's still very high. Now, what some people are saying on the counter argument is, yeah, inflation has come down and it might continue to come down in 2023, but if the Federal Reserve Bank then changes course and they start cutting interest rates, that would force inflation to go higher. So you have some people saying inflation is on the way down, which would push mortgage rates lower. And then you have other people saying, yes, inflation is on the way down right now, but it will go up again if the Federal Reserve Bank changes course. So you have some people saying it's going to go down and then it is going to go up. So this is where we have to kind of predict and guess, which can be a tough thing to do. Now, why is the Federal Reserve Bank working to raise interest rates? Because it's a way to fight inflation. We still have very high inflation, and when you raise interest rates, it makes borrowing money more expensive, which means less people borrow money. If less people are getting mortgages, well, then you see less increase in home prices because less people are buying homes. The Federal Reserve Bank is working to fight inflation. They don't want to see the price of things rise as quickly, which is why they're working to raise interest rates as a way to fight inflation, which is why they want to continue raising interest rates in 2023. So what does this mean for mortgage rates? It looks like if things stay on course, mortgage rates will at the least stay the same, potentially go even higher in 2023, depending on how aggressively the Federal Reserve Bank raises interest rates. Now, of course, this can be balanced out if inflation drops like a rock later in 2023. However, we're still at very high inflation, and while we've been coming down, it is still very high inflation, and it looks like it'll be a number of years before we get down to anywhere near 2% inflation. But I gotta give you a little bit of a disclaimer here, because if the Federal Reserve Bank says, okay, our economy is starting to slow down significantly, we're about to enter a recession, or we're already in a recession, or it's turning into a very bad recession, this is where now the Federal Reserve Bank could change course and say, you know what, we're no longer going to raise interest rates. We're going to start cutting interest rates aggressively, and that would put downward pressure on mortgage rates. So as of today, based off of the information that we have today, it looks like mortgage rates will at least stay the same or go up. However, this can change very quickly if the Federal Reserve Bank pivots, because if they pivot, so will mortgage rates. Now let's switch gears and talk about what influences home prices, and then we'll tie it all together. Now, if you do want to stay up to date on what is happening with the latest in interest rates, mortgage rates, and home prices, the simplest way to do that is to join something like Market Briefs. Market Briefs is a free newsletter that I created to help people stay up to date on what's happening in the financial markets, whether it's the housing market, the economy, the stock market, crypto, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you want to join Market Briefs, I'll put the link to how you can join for free down in the description below. Now, let's talk about what influences home prices, because the two factors that influence home prices are supply and demand. At a high level, understanding supply and demand is relatively easy. When you have more buyers than sellers for a home, home prices go up. When you have more people selling their home than people that want to buy their home prices go down. Then when you start to add in the nitty-gritty of what's actually happening, that's where it starts to get a little bit more complex. So let's start by talking about the supply side. So for the last couple of years and even now, we have been seeing a very severe shortage of homes in America, and we're still seeing that we have a housing shortage going on right now. So we have this low supply of homes, and over the last couple of years, we had massive amounts of demand because everybody wanted a home that they could work from, because everyone was working from home. We had the super low mortgage rates and people wanted to move out of the big cities. So everybody was trying to buy a home and there was very few homes available for sale, and this pushed home prices up through the roof. And today we still have a low shortage of homes. Now what we're seeing happen is that homes are staying on the market longer. Why? Because less people are interested in buying a home. People don't know if they should buy now or if they should wait. So we're seeing the supply of homes go up slightly because of that, because now people are listing their homes and they're not getting as many offers. Then they might have to cut the prices of their homes, and now they're waiting for a buyer to come in and give them a price that they want. So we're seeing homes stay on the market longer, which is slightly increasing the supply of homes. So there's not that many homes for sale, but it's starting to increase because people are not selling their homes as fast. But then at the same time, we're seeing builders build less homes because builder confidence is going down. The reason why builder confidence is going down is because people are entering into contracts to buy homes or to buy brand new homes, and then when they find out how much it's actually going to cost them because of the higher mortgage rates, they're backing out of the deal. And so builders have been seeing so many of their home contracts get canceled that they're less likely now to go out and build more homes because, for one, it's very difficult to build the homes, and now with home prices falling, it's reducing their confidence to go out and build more homes, which is hurting supply. But then we have the last part of supply, which is mortgage delinquency starting to rise in 2023. And unlike 2008, right now, if you don't have the ability to make a housing payment, if you get behind on your housing payment, chances are you'll be able to sell your home for a profit and be able to walk away with some cash. So we're not seeing foreclosures happen the same way that we saw happen before 2008. But if you do get behind on your payments because you lose your job or you no longer have the ability to make your payments for whatever reason, well, that could force you to sell your home. So this is where you can start to see the supply issue is a little confusing, because for some parts, we have some things that are increasing supply. We have more people leaving their homes on the market longer, and we could be seeing more people sell their homes because they don't have the ability to make their payments or they can't afford their home any longer. But at the same time, we don't have as many new homes being built because builders are losing some of their confidence, and we already didn't have that many homes out there for the current amount of demand. Now, the one asterisk that I want to put on this when it comes to mortgage delinquencies is if we see home prices fall further where people are underwater on their homes and then people lose the ability to make the payments on their home, that could cause an uptick of foreclosures, which could really influence where supply goes. But we are near there yet, and that's not something that would happen in 2023. Foreclosures are a long process. They take time to process. They take time to go through the system. So if that's what you're waiting for, you're going to be waiting a lot longer than 2023. So you have to understand that real estate, when it comes to foreclosures and all that, that is a multi-year process. This brings us to demand. And generally what we've been seeing happen is as you see interest rates go up, demand goes down. And demand today is nowhere near where it was 12 months ago when mortgage rates were near rock bottom. So demand has fallen pretty significantly because of the higher mortgage rates. Now what we do see happen is when you see the little periods where mortgage rates do fall, we've been seeing demand start to rise during those periods, but still overall demand is much lower now than where we were 6 or 12 months ago because mortgage rates are so much higher, and it seems like demand is directly correlated with mortgage rates. So if mortgage rates continue to go up, it would push demand down even more. So higher mortgage rates not only makes it more expensive to buy the home, but it also pushes demand down. Both of those factors would push downward pressure on housing prices. So now if we put this together, the trend today at the time of me recording this video, again, I'm going to give you that same disclaimer that this can change any second depending on what the Federal Reserve Bank does. But as of today, the trend is that mortgage rates will continue to rise, while at the same time, when it comes to home prices, supply is shaky, but demand is lower. Both of these things put downward pressure on home prices while mortgage rates are going up. Now, what does this mean? Well, if you're thinking about buying a home, understanding the direction that home prices and mortgage rates go. Now, the one thing that I do want to give you a little bit of a kind of a caveat when it comes to mortgage rates is the nice thing about mortgage rates is if mortgage rates do go down, you have the ability to then refinance your mortgage and get a lower mortgage rate. So I would not try to time the market when it comes to mortgage rates, because if they go down, you can just refinance. And I also wouldn't try to time the market when it comes to buying your own home, but that's a topic for a different video, because we're focusing on now if this is something that you're interested in and you want to understand what direction is the market going, this will help you understand. Now, I'm going to say this again. If you're thinking about buying a home, the most important thing is not what price you pay or the mortgage rate, it's can you afford the home? Can you afford the down payment? Do you have equity in the home? And can you comfortably afford the mortgage payment? If you're going so deep into debt that you have to sacrifice making investments just so you can make a mortgage payment, your home is making you broker. Period. It is not an asset at that point. So if you really want to make sure that you can get a home, don't worry so much about where prices and mortgage rates are. Make sure you can afford the home, because then even if home prices go down, even if mortgage rates go down, you can still afford the payments comfortably and you're continuing to build your wealth. The most important thing is that you're building your wealth in your investments, not in your home. Because if you're building your wealth in the investments, these investments will continue to pay you even after your mortgage is done. That's the most important thing. But then understanding, where is the housing market going? Well, as of today, home prices are on their way down, mortgage rates are on their way up, but this can change in a second if the Federal Reserve Bank flips. If Amazon sees their stock crash, well, now you can see your value drop in half almost overnight, because you can see these huge swings in stock market valuations very quickly, because the stock market is liquid and it can be very emotional. With the housing market or with real estate, it's a little bit different. You can still see swings up and down, but you're not going to see